guys.
Good day.
Hello.
Okay, so this is us. We're going?
It is you.
Okay, thank you very much. This is a co-presentation between me and Ricardo, two portfolio managers at Antares. I'll start by thanking Michael and New Outlook Wealth for having us participate in this. We're very excited to be here, and we're going to tell you our story this morning. So the title of our presentation is Two for the Price of One. And the idea here is that what we do, what we endeavor to do is to add value to clients. And there are only so many things that a person can do well. Earlier in my career, I worked in a financial planning office. This is a long time ago, and financial planning is very tough, and I eventually made the decision to go into investment management, but I have a great deal of respect for the financial planning process and for the knowledge that you as financial planners have and the value that you bring to clients. We don't do financial planning, so the basic idea here in our presentation is that financial planner plus portfolio manager work together in the best interest of their clients for a fee or a price that is fair. In other words, two for the price of one. So today we are going to talk about our firm Antares. Critically, we're going to talk about how it is that we work with you as financial planners. We'll tell you about the people at our firm, our investment philosophy, and how we implement that philosophy through our investment process, and we'll give you some examples as well, so some stock examples in the portfolio. So Antares is a Winnipeg-based firm, started in 2004 by our colleague Jerry Bettig. We're an independent firm. We value that. The research we do isn't dictated from on high by some big firm. So that is a very key part of our value add to clients. One of the differentiating factors at our firm is that we have more than one approach to executing on our investment philosophy. We have three strategies. Two of them are managed by Ricardo and me, that is to say total equity and balanced. And our initial strategy is managed by Jerry Bettig, the value strategy. So we bring these different strategies to clients, sometimes in conjunction with one another, affording them some diversity in their portfolios and some of our best ideas. In addition to that, I want you to know that clients can hold our portfolio in different ways. One of them is through separately managed accounts. So those are where you own stocks and bonds individually, as well as in pooled format. So the pooled format would be a model type of portfolio in a mutual fund-like structure. However, it is proprietary to Antares, and the purpose of it is to provide smaller accounts with adequate diversification. So we might use that in a tax-free savings account or an RESP, etc. Many of our clients hold both a separately managed and a pooled solution within their aggregate household portfolio. Something else I want you to know about our firm is that we just do investment management. So we have 15 employees here, none of whom are in sales or marketing. So the people who do the sales and marketing, like me, Ricardo, and Jerry, are, temperamentally, we're propeller heads and analysts who are sort of more inclined to do research and analysis. But we also do our best to talk to the public. But the point is that, as portfolio managers, job number one is to take care of existing clients and make sure that their assets are preserved and are able to grow over the long term. But as business people, we of course want to grow our business. And to the extent that we're not marketers or salespeople, we look to partner with you, independent, ethical financial planners who have trusted relationships with clients. So that's how we grow our business in terms of getting new clients. We work with you to do right by clients. A final point I'll make is that as investment managers, we don't have some separate mystery aggressive portfolio for our own money. On the contrary, we invest all of our own personal money, the money of our spouses, and in some cases our extended families are in the very same portfolios that all of our clients hold. The point being that we are fully aligned. Every decision we make matters to us. Okay, so now I'm going to talk a little bit about how it is that we work with financial planners. And the key point here, of course, is that we do different things. The things that we do are complementary. We both work for the client together, but we provide different areas of expertise. So financial planners, as you know very well, I don't need to tell you this, clients don't always know the difference though. So sometimes we need to let clients know that we do have different roles. So of course you're focused on things like planning for estates, helping with corporate structures, the appropriate insurance, mapping out cash flows for retirement, succession planning, education planning. All of those types of things are the purview of financial planning. We don't do that other than in a very peripheral way. What we know about financial planning is just enough to get into trouble. So we prefer to have you take care of that. Where we endeavor to add value is through investment management, proper, so to speak. So, we do the research. Our research is proprietary. We focus on the equities, we focus on the asset mix for clients, constructing the portfolio for the clients consistent with what their objectives are, and of course, monitoring the portfolio and rebalancing it over time. So these roles, while I suppose theoretically it is possible for one person to do them, it is difficult to be an expert in everything. And so the basic business model and the basic value add model for clients is that we have two experts working for the client. And the idea behind this chart, which builds on the last one, is simply that there are areas of crossing over, right? So the taxes matter to you as a financial planner. Well, we also value that information when we're working with clients in their taxable accounts, retirement time horizon, cash flow management, etc. One of the things that I personally like very much about working with financial planners is typically you have a long history with your clients. You know how they responded, say, in the 2008-2009 financial crisis. You've been with them through downs and ups. You also have a good idea of what it is they're looking to achieve, et cetera. So when it comes to the asset mix decision for a client, we fulfill our obligation as portfolio managers and registrants, but we're very interested in what you have to say. And that input feeds into our decision making. Ultimately, we are responsible, according to the regulator, and indeed we are responsible for making these decisions, but we value your input. And so we view our relationship with you as a partnership. So as portfolio managers, some of this builds on what Todd talked about earlier. We hold the CFA designation. We are held to a fiduciary standard. There are three of us here, myself, Ricardo, who will be talking shortly, and Jerry, who's watching with interest and always has a lot to say. So he's probably chomping at the bit and wanting to participate, but he's not participating in this. But we are all very receptive to receiving contact from you individually. We love working with financial planners for clients. Between the three of us, we've got something like 60 years of investment experience. We also work with an analyst who's working on her CFA designation, challenging level 3 as we speak, who we hope is going to graduate into the role of associate portfolio manager. And we have a trader who works with us very intimately, helps us execute on portfolios. So that's a little bit about the firm and the people. Now I'm going to talk a bit about our investment philosophy. And I did mention to you that we do have 3 strategies that we have for clients, but all of those strategies, although they are different in terms of execution. They share a lot in terms of philosophy. It's the execution that's different, but the philosophy per se is generally very similar across the board. And by the way, we see that as a strength, because although we execute differently, we can work together in terms of research. We can leverage one another's research, even if we make a different decision on a given stock or bond. So, you know, the sort of at the front end of our thinking on investing is that when one is investing in equities, one is investing in a company. So we're not like those dudes you see on TV with all the flashing lights and the hammers and whatnot. Investing is not a game show. Those types are motivated to get you to trade, right? It's all about trading commissions, and their advertisers are all brokerages. That's not how you make money in the long run for clients. It's about investing in businesses, in companies. And typically, the very wealthy hold a relatively small number of businesses that they've held for very long periods of time, because the best businesses are the greatest compounders. And the way compounding works, as we all know, is time. It's time in the market, time in these companies that creates the wealth. So, you know, having said that, there are many other investment managers who share that view, but the way they think about investing or the way they enact it is still different, and that's fine. One of the things that we believe differentiates us from other Canadian investment managers, not all of them, but some of them, is that we start with the question of what are the best companies to buy. And in that sense, we're different from some of our competitors who ask the question, well, how much should we put of the client's investments in Canada? How much should we put in the United States? How much should we put in Japan or Australia, or pick your geography? There's nothing intrinsically wrong with that, by the way, but we don't start with that question. That question comes up later in the analysis. And the reason for that is there are a small number of great companies out there. Canada, being a relatively small country, is likely to house fewer of those great companies. So we want to look around the world for ideas. And so therefore we do that. We look around the world. And because there are so few companies, we want to make sure that we're able to spend the time doing the research to understand them well. And we want to own a relatively small number of them. Now, we want diversification for clients. So typically we own upwards of 20 to 30 companies in the portfolio, but we don't own 200 companies. We don't own 15 mutual funds, which themselves own 200 companies or 3,000 companies. We don't believe that that is the way to do it. We want to own a relatively small, focused list of companies that have diversification, be it by sector or geography, et cetera, or by business drivers. So the diversification is there, but the ownership is meaningful. We want meaningful ownership because that is what is going to lead to compounding. Another key value we hold is, you know, as Todd mentioned earlier, keep it simple. Keep it simple. So the simplicity we believe is key, and the transparency is key. When clients know what they own, they're more likely to be committed to staying the path. And the commitment is especially important in market extremes, be it extreme bull markets, where you have to talk them off the ledge from owning whatever is raging and owning the quality compounders, as well as the extreme bear markets where people just give up hope and want to put all their money in a mattress. So the transparency and the simplicity help keep clients on track. And the final point is that investing works best with a financial plan, because at the end of the day, I think you as financial planner are providing structure to a client, and we are providing structure in the portfolio itself. More structure means less is left to chance, and therefore the odds of success are higher. Okay, so on the theme of keeping it simple, the way we talk to clients or the way we explain our process is we invite them to imagine a three-legged stool. So it's keep it simple stool. And each leg of the stool represents an element of our investment process. Now, of course, it's a lot more complicated than this, but who needs a complicated explanation when we can say it with three simple ideas? The first idea is that we favor companies with strong balance sheets. The balance sheet is the financial statement that lists the assets, the debts, and the equity in the business. And it's the debt that we are most interested in the sense that being by nature or by character, perhaps a little more conservative, we want companies to have moderate debt levels relative to the earnings power of the business. Moderate debt means the company is unlikely to get into trouble when things go wrong. For example, when there is a recession, because we know that there typically is a recession every 6 or so years, well, companies still have to make their interest payments and their rent payments and all of that. If your sales are down 40%, it's tougher to make if your debt is very high. So lower debt is a good thing in our world. It reduces the odds of some kind of permanent impairment of the business value. That's a great starting point. The second element of our investment process, or the second leg of the stool, is we want companies that are profitable. Ideally, we want those profits to be consistent, because consistent profits are evidence of a quality business. The higher the profits, obviously, particularly within an industry, when you have a business with higher profits versus its peers, that is an indication that a business has some sort of competitive advantage. Competitive advantages mean the business is better able to create value in the long run. And critically, for clients who are looking for cash flow, it's those very profits that generate the ability to share some of the profits in the form of a dividend. Dividends are great for retirees because they get income that can grow and offset the cost of living. And dividends are still good for savers as well, because those dividend payments can be re-plowed back into the portfolio and contribute to the long-term compounding of the portfolio. So these things are good when you pair them up with a financial plan, in our view. Third leg of the stool is the price we pay for the business. Numbers 1 and 2 on this chart alone are very good because they're indicative of a quality business. But a quality business does not necessarily entail a great investment for a client, and the price is a critical component of a great investment. One who overpays for a great business may not have a great return. Conversely, one who can get something for a bargain, or at best, or a fair price, is more likely to have a good to great return as an investor. So our view is that we want to pay a fair price for a great business. And when we can find a bargain, we love bargains. My name is McIsaac, so I don't like paying full price for something. If I can get it for a bit of a discount, I'm all the happier. Let me give you an example of a real historical example of why price matters so much. So the next 2 slides are showing you the stock chart of Microsoft. This first one starts in 1996 and it goes to 2001, if I see it correctly. And of course, the late 90s were that tech bubble, right? Where all tech stocks were going to the moon, new paradigm, all that stuff about markets going up forever and never coming down. And Microsoft was one of the participants in that rally that turned into a bubble. At the end of 1999, the stock peaked at $60. And in the ensuing years, and by ensuing, I mean the next dozen plus years, the company's sales and profits rose by a compound growth rate of something to the tune of 9%, if I recall correctly. So this is a company that was growing faster than GDP. It was a very solid company with a clean balance sheet, high levels of profits. They introduced a dividend and grew it consistently. They bought back lots of shares. They created value. However, had you been that poor sucker who bought the shares at $60 in 1999, and that's the red circle you see on this chart, it took you 16 full years before you got back to $60. Even though the company was a great company and compounding in value as a business, you just paid too high a price. So the price you pay for a great business matters a great deal. The good news for Microsoft shareholders is that subsequent to that period of time, the shares were very cheap. So by the time you got to that green circle, the price to earnings ratio, the free cash flow yield, et cetera, were extremely attractive. It had become a value stock over those 16 years because the earnings grew so much. And it has subsequently become a very good investment and gotten more expensive in the process. So those are the words that I'm going to say. I'm going to hand the baton over to Ricardo. Ricardo, I'm going to, Ricardo, if you can take over, do so. Are you able to?
Yeah, I think so.
Okay. Okay.
Let me know that works.
I'm going to approve the handoff here.
Okay, let me just make sure that it works here. Control share screen. Okay, yeah, that works. Perfect. Thanks, Alec.
Off to the races, Ricardo.
Thank you, and good morning, everyone. I hope everyone's doing well. Michael, thanks for putting this event together. We're excited to be here. I know these can be a lot of work, so we appreciate the invite. So what I wanted to do today was to just sort of build on what Alec was talking about in terms as it relates to the three-legged stool, or the three criteria that we look for when we're looking for companies. So I'll give you some examples of some of the companies that are currently in the portfolio and how that three criteria fits into the decision making. So the first company that we wanted to look at, and I'm not sure why that changed. Just one sec here. Did you move anything, Alec? Something happened. Okay, I think we're good. Okay, so the first company is Novo Nordisk. Novo Nordisk is a Danish pharmaceutical company that primarily serves in the diabetes and obesity markets. Now, Alec talked about one of the criteria being consistency in profitability and cash flows. And this company fits that criteria quite perfectly. If we look at a measure of profitability, normally we use return on capital to measure profitability, and there's many other metrics that we can use. But if you take a look at Novo Nordisk and rank it with some of the other large pharmaceutical companies, what you'll see is that Novo Nordisk every year is at the top. Returns on capital are over 50% consistently, where the next competitor will be, it's not even close to that, for about 30%. So when you see numbers like this and you question yourself and you ask, okay, why is that? Why is a company so profitable? And then when you start digging a little deeper, what you see, and I'll give you some facts here, is that Novo Nordisk, for example, has a 30% market share in the diabetes segment, 50% market share in the insulin segment, and a 60% market share in the obesity care segment. So these are segments of the market that are in high demand, and there's lots of tailwinds for these diseases and for their products. So that's where you can kind of start seeing, hey, well, this company is profitable because it's a leader in the market, and those are the type of companies that we want to see. Now, aside from the profitability and consistency, what we also see is that the company, as Alex spoke, has a really healthy balance sheet. It has $2 billion in cash and also has no debt. So it has a lot of firepower for whatever capital allocation decision they want to make, whether it's paying dividends, buying back shares, putting that into R&D, which is, for a pharmaceutical company, research and development is very important, or they can make acquisitions if they want to grow the business a little inorganically. So this is the company that, again, high quality. It's been part of the portfolio for a few years now, and we plan to hold it for a while. Now, the next example of a high quality company that again meets that criteria is Cisco Systems. And to put it in simple terms, Cisco provides the backbone that makes the internet work. So if you're thinking about switches and all the hardware and software that makes networks work, well, Cisco plays a big part of that. And it's not as a popular stock as an Apple or the Googles of the world, but it's a company that consistently has shown high levels of profitability. And again, if you want to look at why this business is highly profitable, and you look at some stats, well, it has 19% of the market share in the IT network segment, 50% market share in the Ethernet switch market segment, so that's again 50, and 43% in the WLAN market. So again, you have a company that's essentially a leader in what they do. Also important to keep in mind that this industry has very high switching costs. So if you're a customer of Cisco, it's very, very difficult to switch to a competitor, because when you switch to a competitor, you may have to put the brakes on how your business operates while you switch to a competitor. So there's a lot of stickiness in the business, and that reflects in the profitability of the business. When we look at the balance sheet for Cisco, $29 billion in cash just sitting on the sidelines, and the company has more cash than debt. So it has a lot, again, that firepower, that optionality to do whatever they want with the cash. The next example, and Alec touched on some of the things that we look at as being evaluation and how it is important, because there's a lot of quality companies out there that we'd like to own. But if the price is too expensive, yeah, you can own the company, but you may not make money on over the long term, because valuation at the end matters. And Wells Fargo is an example of a high quality company that we saw in the, well, we've seen it, we've followed it over the past few years as being cheaper than competitors. And last year we saw that company hit rock bottom. And well, as we all know, it has its own issues, reputational issues, as a result of the account fraud scandal. But if you look at the company historically, it has had some of the highest net interest margins in the industry and some of the highest returns on equity in the industry. So you look at a company like this trading very cheaply. Historically, it had been trading at about 1 times book value. When we looked at it last year, it was trading at 0.6 times book value. So you have a quality company that's very cheaply. So what do? Our question when we looked at Wells Fargo was, well, are the issues from the past, are they fixable? Is there something something that cannot be fixed that would potentially affect the business long term? And as we did our research, our view was that these issues are fixable. The company put in a new management team. They've been working closely with the regulators to basically clean everything up, all the messes of the past, and we decided to go ahead and purchase it at what we believe was a very discounted value. So we bought it at 0.6 times book value. Now it's at about 1.1 times book value, so it's come back up since, and we believe it still has a lot of room to grow. There's still a lot of things that they have to fix. They're not there yet, but they're doing the right things. So again, this is an example again of a high quality company where we usually look for fair valuations, but sometimes you have companies that just trade at extremely cheap valuations, and we'll take the opportunity when the opportunity comes. Perfect. So these are just 3 examples. We have 30 companies in the portfolio, so if you guys have questions down the road, we have our contact information here, so I'll be happy to run through more examples. But just to end this part of the presentation, we believe this approach works. We've worked with advisors and their clients for many years. The feedback that we get from clients is that They feel that the decisions are made on their behalf from the financial planner and from the portfolio manager. They feel very confident with that level of teamwork and professionalism. Now, if you add, for example, obviously there will be some clients that have more complex needs, and they may have an accountant, or they may have a lawyer in the mix. That can be part of the team, right? And that's something that we do for some of the clients that are in that position. So in the end, the client gets high levels of service from a portfolio manager and a financial planner. They get a financial plan, which is the backbone in all this, in order to meet their financial needs. They get a high quality portfolio, and they get cool people working for them, and I think that clients appreciate it. And so that ends my part of the presentation. Michael, do you want to pass it on to you? I appreciate your time.
Sure, thanks, Ricardo. Alec, I see you're still there. Is there some stuff you'd like to add to that? We still have a few minutes left before we go on to the next presenter.
Michael, we could have added 6 slides to this and kept on going. I've been guilty of that often. This is our story. I mean, at the end of the day, it's about collaborating together. You talked about the theme of fairness at the outset there, and we're fully on board. We think the model that we bring fits that criteria, and so I'll leave it at that. If there are any questions, we're happy to entertain them, but we don't need to talk for 45 minutes. What we'd rather do is follow up with people and help clients.